Hey everyone, I'm Professor Franklin. Today I want to ask you an important question. What actually happens to the stock market when war begins? Do markets crash immediately? Do investors panic and sell everything? Or does something very different happen? History shows that wars create fear, uncertainty, and major economic shifts. But interestingly, the stock market doesn't always behave the way people expect. Today, we're going to explore how wars affect financial markets, investor behavior, and global economies. So think of this as a short lecture on war and the stock market. Let's begin. Now, class, the first rule of financial markets is simple. Markets hate uncertainty. Investors prefer stable environments where they can predict economic growth. But war introduces uncertainty into the global economy. When geopolitical tensions rise, investors begin to worry. Will trade be disrupted? Will oil prices rise? Will the global economy slow down? Because no one knows the answers, investors start reducing risk. Many investors move their money away from stocks. Instead, they shift their capital into safer assets. Economists call this behavior a flight to safety. And during these moments, markets become extremely volatile. Now, class, something important often happens even before war begins. Financial markets react to tension long before the first shot is fired. When political tensions rise between countries, investors begin to prepare for possible conflict. Stock markets may decline because investors fear uncertainty. News headlines, political speeches, and military movements can all influence investor sentiment. Sometimes markets fall simply because investors expect something bad might happen. In finance, expectations can be just as powerful as reality. Now, class, let's examine history. Financial markets have experienced many wars over the past century, and surprisingly, markets often follow similar patterns. Before World War II, markets declined as uncertainty spread across the world. Investors feared a long and unpredictable conflict. But once the situation became clearer, markets began to stabilize. We saw similar behavior during the Gulf War in 1990. Markets dropped before the invasion, but they rebounded once the conflict became more predictable. Even after major global shocks like the September 11 attacks, markets eventually recovered. History reminds us that markets often recover after major crises. Now, class, here's something fascinating. While wars can hurt many industries, some sectors actually benefit. One of the biggest winners is the defense industry. During war, governments increase military spending. They purchase weapons, aircraft, and defense technology. This often increases revenue for defense companies. Another sector that can benefit is energy. Conflicts can disrupt oil supply chains. When supply becomes uncertain, oil prices often rise. This can increase profits for oil and gas companies. Now, class, let's talk about government spending. Wars are extremely expensive. Governments must spend large amounts of money on military operations. This includes equipment, logistics, technology, and personnel. Defense companies often receive massive government contracts. Factories increase production to meet military demand. This sudden increase in spending can stimulate parts of the economy. However, wars can also increase national debt. Governments often borrow money to finance military operations, and this can create long-term economic challenges. Now, class, here's another important concept: safe haven assets. During times of war or global uncertainty, investors often move their money into safer investments. One of the most famous safe haven assets is gold. Gold has been considered a store of value for thousands of years. When uncertainty rises, demand for gold often increases. Another safe asset is government bonds. These bonds are often considered low-risk investments. Investors use them to protect their capital during uncertain times. War can also influence global currencies. When global tensions increase, investors often move their money into stronger currencies. The US dollar is often considered a global safe haven currency. During crises, demand for the dollar may increase. This can influence exchange rates across the world. Currency movements can also affect international trade and investment, because global markets are deeply connected. War affects more than just financial markets. It can reshape the entire global economy. Conflicts can disrupt international trade routes. Supply chains may break down. Shipping lanes may become unsafe. Countries may impose economic sanctions. These disruptions can increase prices. Energy prices may rise. Food prices may increase. And inflation can accelerate. Now, class, let's talk about investor psychology. Financial markets are strongly influenced by human emotions. Fear spreads quickly during global crises. Breaking news headlines can trigger panic selling. Some investors rush to sell their stocks. Others remain calm and think long-term. Experienced investors understand that markets often recover over time. They avoid emotional decisions and focus on long-term strategies. Now, class, experienced investors often look at crises differently. While many people focus on fear, some investors look for opportunities. Market declines can create chances to buy strong companies at lower prices. History shows that long-term investors who remain patient often benefit when markets recover. This is why disciplined investing is so important, because emotional decisions can lead to costly mistakes. So, class, what have we learned today? War introduces uncertainty into financial markets. It increases volatility. It disrupts global trade and supply chains. But history shows something surprising. Markets often recover once uncertainty begins to fade. Financial markets have survived wars, crises, and global conflicts throughout history, and they continue moving forward. I hope today's lesson helped you understand how war impacts the stock market. As we've discussed, wars create uncertainty, volatility, and major economic shifts. But history also teaches us that markets are incredibly resilient. They have survived global conflicts, financial crises, and economic downturns throughout history. And time after time, markets have found ways to recover and move forward. For investors, the most important lesson is to stay informed, stay patient, and avoid making decisions based purely on fear. Because understanding how global events influence financial markets can help us become smarter and more disciplined investors. I'm Professor Franklin, and this has been today's lecture. If you enjoy learning about finance, economics, and how global events shape the markets, make sure you continue exploring these topics. The world of finance is constantly evolving, and every major event teaches us something new. So stay curious, keep learning, and always look at the bigger picture. Because the more you understand the market, the better prepared you'll be for whatever the future brings. I'll see you in the next lesson.